let's just give let me just sort of
Good evening, sir.
Oh, I was just sending a message to you.
Oh, okay.
I was sending you a message, so I can now cancel that. Okay. So today, now, what we'll do is we will go ahead with the whole dividend thing and finish that section on dividends, and then proceed to the valuation of, like valuation is a big thing in finance. Understanding what the actual value of any asset is. So we look at that, and we'll start with, let's say, the most, it's very well-known calculations of bonds. So we'll do that part, and then that today, of course, I'm not sure where we are going to reach today, but basic idea is I finish dividends today. And after dividends, if we have a lot of time, then of course I will start off with the bond valuation. But if we have, let's say, less time, then what I'd like to do is do some revision of what was done before, because tomorrow we'll have a quiz. Tomorrow we'll have a quiz. I'll try to, let's see if you people are okay, we can have an online quiz. So you'll all log into that site. The questions will come one by one, and you can. It's pretty good, it will immediately rate each of you, like who is going ahead, who is coming below, like that. So we can do something like that. It will also test your knowledge over, the last month or little more than a month, whatever we've done. You will get a good idea about how much you remember. At the same time, if it also brings up, areas which you need to, let's say, revise, or which you need me to intervene, you can speak about that also. So let me just share this slide here. So basically today we'll be focusing on this, the dividends part. So last time, remember, we spoke about dividend, and we said that it's a cash payout paid by a company from its profits, and it should be paid from profit. And then we said, is it relevant or not? So there was this concept of a dividend irrelevance theory states that dividend is not relevant for investors, as they have the option of selling some of their shares in the market to generate cash if they need funds. So market behavior shows that dividend payouts minimally affect share price. See, that is one view. The other view is that when a company is very regularly paying dividends, it does have a good impact on the share price, because when a company pays dividends, the basic signal that it gives to the market is that we are doing well and we have the money to pay for the capital that you have given us. So remember, the dividend is the counterpart of interest. So in the case of debt, you will have interest. In the case of dividends, in the case of shares, you will have dividends. And so most companies would think of a dividend as an integral part of their corporate strategy. And of course, the amount, timing, and things like that, that is left to the management. So the other aspect of dividend, which you'll always, please always remember this, there is a trade-off here between current consumption and future consumption, in the sense that if you, yes, Lokesh?
Just telling, sir, retaining the earnings, sir.
So we come back to the famous trade-off between what you want today or what you want tomorrow. If you're willing to put off, let's say, your current gain for something you want tomorrow, then in that case, probably you would prefer to take that money, invest it in the company itself, and then over a period of time, let's say the sales of the company builds up and you get even more profit, and then you ultimately get back a higher dividend. But the whole concept is that is in the future. This is something you're going to get today. So definitely there is that feeling that, like all of us want money in hand. So that is always something which is preferred in many cases. But it's a decision for the company to actually make. So what do they actually want? So one very interesting thing here is that the future return on equity, or the return which the shares are going to give you, is going to depend to a very large extent on the amount of money which is sort of reinvested in the company. And if the investments are not made, then in that case, it's possible that it will stagnate. The growth rate can stagnate. That is the point to always remember with regard to dividends. So a low payout policy where you're giving less dividends might produce a higher share price because it accelerates earnings growth. Investors of growth companies will realize their growth mostly through capital gains resulting from appreciation in share value. So this is one thing. See, there is another parallel which you can think of here. Many of us who invest in the share market, quite often you wait for the share prices to rise and then you sell it. You say that, okay, fine, I'm getting a 20% gain on my investment price. So let me just sell it and book my gains. It happens quite a lot. Huh? Lokesh, I think I'm right here.
Yes.
So I remember when way back in the early 2000s, Maruti was definitely a good company then as it is now. So all of us had invested in Maruti. And then the day came when the share prices rose a lot. And most of us were getting a very handsome return on the entry level payout which we had made. And the result was that most of us actually sold. But the fact remains that had I stayed with Maruti over these years, then possibly the amount of money I would have made by the sale of the share today would have been so much more. So by leaving it to the future, sometimes you get a much, much better return than immediately in cashing what you can get. So the same thing applies to dividends also. So if we reinvest in the company, allow the company to grow bigger, it will definitely help. So that's one point. And then I showed you these, the consequences of high payout and low payout, where it's very clear that where a company is paying, let's say, very low dividends, so it has a very high dividends in this case, where it is, let's say, if it has an earning of at 20%, so let's say if this is 100 crores and they have a 20 crore earnings.
Profit.
Yes. So they give a dividend of 16 and they retain 14. And there's this other company which basically gives a dividend of 4 only and retains 16. And then over the years, mainly because of the effect of compounding, and of course, one assumption here is that when, let's say, funds are retained, profits are retained within the company, this company has opportunities to invest that money. So that assumption is always there. So keeping that in view, over a long period of time, we saw that the company which had a high payout system actually lost, and the company with the low payout system did much better. Their shareholders would have actually increased their wealth by a whole lot, and in the days ahead would get an even better dividend. So you can see here, like let's say, even if you take the 10th year, you will see that they are already getting a higher dividend than these people here. So this was one point. We saw the same sort of thing in this graph, which basically repeats the same. And we then sort of put our, all the conclusions that we had drawn from those tables and graphs, we put them here. A high payout policy means more current dividends, less retained earnings. So this may result in slower growth and perhaps lower market price per share. So dividends are current earnings and can be taxed at a rate higher than capital gains. I think Lokesh confirmed that this is the case. So that is also there. It is a difficult decision for the company. So if an investment is to be made from the profits at the cost of giving dividends, the dilemma is which to prefer. If the company pays dividends, it may have to raise funds to make the investment. That is another thing to always think about. See, the moment you pay a dividend, money is flowing out of the company. And if you now, after that, want to make an investment, the only way you can do it is to raise funds all over again. So then we had a look at, like different companies, and we saw dividend and capital structure here. And we saw that there are some companies which give as much as 100% dividend. And there are some companies like, for example, Britannia, 100. And there are some companies like Marico, which give an almost 187% dividend. And some companies which do not give dividend at all. In this example, the companies who have not given dividend have actually been in loss. So that is the reason. But then there are other companies like, say, Asian Paints, which are in the middle. So they give a 55% dividend, they retain 45, and they use that to keep building up the company. Asian Paints, is always, I find that a very good example, because this is the company which has used the profits that it makes consistently to grow consistently. It keeps growing, keeps thinking of new ways of sort of capturing its market, of coming out with new ways of selling. And when you study the company, you realize that the strategy is not just based on superior product. It is also based on ensuring that other aspects of the whole process are more efficient. So, for example, making sure that the dealers are, they have a minimum stocking need. They don't need to stock too much. Their inventory can be replaced at short notice. And there are cases in Asian Paints where in the metros, they are actually able to deliver twice a day to dealers. The logistics are that good. So these are companies which have invested a lot in data management. So one of the reasons for their growth has been that they have plowed back money into their own company and used it for understanding their own business better, and then using it in a very, very effective way. You guys might remember right in the beginning, when we were looking at corporate strategies, we had looked at Amul also, and how Amul had done very well during COVID, whereas other players in the same, in the milk business actually didn't do that well. And one of the reasons for that was that Amul also had made an investment in computers, in data management, and which at that point of time had paid them huge dividends, allowed them to encash that, let's say, that potential that they had and make money at a time when most companies were not doing well. So we saw that different companies have different methods of using the money that they have. And then we looked at these different models. Walter's model was there. And then, so these are theoretical models, which I had basically given to you so that you understand, the amount of work which has actually been gone into understanding whether dividends are good or bad. or whether they should be done and what is the optimal amount and things like that. So, and ultimately we reach this, this comfortable conclusion in the Walters model that ultimately the decision to give a certain amount of dividend is based on the maturity of the company. So companies which are lower in the, just beginning where they need to grow, they would prefer not to give high dividends. They would prefer to retain the profit within the company and allow it to grow. Whereas companies which, let's say, are mature, let's say like Britannia in our example, they are comfortable giving very high dividends because they are already there. They have a very, very stable revenue stream, and they are able to give a huge amount of money back to their investors. So it all depends on at what level the company actually is in its growth. So that was one. And then we spoke about this concept, the signaling theory, where we said that, so remember, share prices ultimately depend a lot on the perception of the investor. Share prices sorry guys, that was a call that I got. So anyway, so one of the things which dividends do is that, see, share prices ultimately depend on the perception of the investor. And when people, look at the performance of the company, they take a decision on whether they want to buy that share or not. So a company which is giving dividends gives these people a positive signal, and that is something which can generate demand for the share. And when it generates demand for the share, it can also lead to an increase in the price. That is the basic logic behind this signaling theory here. And so we said that quite often, if a company is paying dividends, it gives a very positive signal of future growth. And then we discussed what the informational content of a change in dividend policy could be. So where a sudden change in dividend policy is made, depending on what the company has done in the past, it can have different messages for the shareholders. So we gave this example, suppose a company is following a policy of paying a dividend of ₹2 per share against earnings of ₹4 per share. So it's a 50-50 balance. Now suddenly the company's earning per share goes up to ₹7, but it continues to pay ₹2. So what is the assumption made by the shareholder? The assumption is basically that the increase in profit was a one-time one, and the demand for the shares may not increase so much. Because even though the EPS has gone up, the company continues to pay the same dividend. So you feel that maybe the company is not hasn't hit that very stable place where it will have a consistent increase in its dividends. Suppose with the same result, an EPS of 7, the company decides to actually pay ₹4 per share. In that case, the assumption could very well be that the company is expecting to have a consistently higher profit in the days to come. And that positive message that goes helps to generate demand and increase the, let's say, the share price of the company. So these were some examples, and then we looked at these different policies: the stable dividend policy, the constant dividend policy, the residual dividend policy, and then finally, if I remember correctly, the point I was making to you was that most companies actually go by this, the residual dividend policy. So Lokesh, this residual dividend policy, would you agree that generally companies would be going for this method only?
Yes, sir. Big companies all adopt this method only.
So Anjali, are you there?
Yes, sir.
So do you remember this residual dividend policy?
Sir, first retaining.
Okay. So for your benefit, Anjali, let's just go over this again. See, when a company pays dividends, now some companies adopt different approaches to the payment of dividends. So some companies may simply say that let's have a very stable policy. We pay the same percentage of income to our shareholders year after year. So whatever is the profit, we will pay, let's say, around 50% to our shareholders. So that's like a stable dividend policy. But some companies, and in fact, the point we are trying to make is that most companies adopt what is known as a residual dividend policy. So residual means what? Whatever is left over. So basically, in a residual dividend policy, what it means is that first the company will make space for its capital expenditure. So if it wants to expand, let's say it needs to replace some machines, or it needs to put in a new line of production, it needs more working capital, it will first use the profits that it has to look after these needs. Because remember, profits are the cheapest source of internal capital. So basically what happens is they'll use it for that. If after that they have something left over, whatever is the residue, that will be used for the payment of dividend. That is the basic concept here in residual dividend policy. So we looked at this, and then we sort of looked at the different factors which influence the dividend payout ratio. So where we looked at the maintenance of reserves. So as far as the maintenance of reserves and provisions and all that is concerned, in the banking industry, for example, this is a huge use, because banks are expected to maintain a certain level of provisions for expected loss due to their bad loans. And if they pay out dividends, or if they show a very high profit and then pay out dividends on the basis of like very low reserves, in the long run, it could hurt the bank in a big way. So banks would want to make a good provision. Provision ultimately is an expenditure which will reduce your profit, and then go for paying a dividend. So this is one. And another important part here was, they will, of course, we've already mentioned this, if they have a need for growth and expansion, they will give priority to that. There can be dividend restrictions by creditors. This is something which in the Indian context, I would say is not that relevant. But if you go abroad, where, let's say, the grip of finance now over the borrowers that it has, or over the companies, is much, much stronger, their banks can actually dictate that, look, we don't want you to pay out dividends. We'd rather that you follow a low payout policy, be conservative, build up your company, and make sure that you're generating sufficient surplus to pay our interest. So creditors can actually influence the dividend policy. And of course, if you need fixed assets and all, we've already done that. Now we look at other forms of dividends. So far, we've looked at the actual cash payout. But there are other ways of returning money to your shareholders. And the main part of today's session is going to be on this, these other ways. So first, what we discussed was the cash dividend. And the norm is that companies will mostly pay cash dividends. If balance is not available in its account, it can even borrow funds. So let's say it has, the profit is there, but the cash is not there. There can be situations like that, where the company has made a profit, but the cash is not there in its bank account, in which case it can even borrow, but ensure that dividends are paid. That option is there. I'm not saying that they do it, but that option is there for them to use. what happens actually when a dividend is paid? Dividend is paid, the reserves and surplus account is reduced by the amount of dividend. Correct, Lokesh?
Yes, sir. It's
So
paid out of reserve.
it has to be paid from the reserves and surplus.
Okay.
Now, the other way of returning money to shareholders can be through bonus shares. Now, basically, Anjali, you've come across this bonus shares? Any idea?
Bonus is something which the company provides to its employees at the time of profit.
Okay, so one form of bonus is where you are giving something extra to your employees. So let's say that over and above the salary that you earn, you give them a bonus. So in let's say it's a big incentive for you. Look, if you do well, if the company does well, over and above whatever salaries you're getting, you'll get a bonus. Now, similarly, another very big stakeholder in the company is the person who invested in the company. So the company quite often, not often, but the company can give bonus shares to its shareholders. So here it's not a bonus, Anjali, it's bonus share. So basically what you're doing is you're giving more shares to your existing shareholders, but you're giving it to them free of cost. So let's say you have 50 shares and the company says that everybody who has 50 shares, we'll give them 10% more, 5 more shares. So those 5 shares are given to you. From 50, you will become 55, but they will not ask for any money from you. That's the basic concept in a bonus share. So this is another way of giving money back to you. They're giving you something in return for the investment that you made in the company. Now, in India, there is a clause, a legal requirement that bonus shares can only be given in addition to dividend, cash dividend. This is correct, Lokesh?
Yes, sir.
So you cannot say that in place of dividend, of a cash dividend, we will give a bonus share. What you have to do is you can make a small cash dividend and then the rest of it you can give through bonus share. But the point is that you have to make that cash dividend even if you want to give a bonus share. Now, what will happen if you give a bonus share? One very simple thing is that the number of outstanding shares will increase. That there is, let's say that if you had 1 crore shares in the market, you decide to give 10 lakh more shares. Ultimately, the total number of shares in the market are going to be 1 lakh 10. Now, what happens to the price of the shares is a different issue. But the actual number of shares floating in the market are going to increase.
Right.
So bonus shares are issued proportionately. For example, if a shareholder has 100 shares, company decides to give a 10% bonus issue, the shareholder will get 10 shares. Now, these 10 shares which the shareholder gets, that shareholder is not expected to pay anything for these 10 shares. Anjali, you got the basics of this now?
Yes, sir.
Fine. So you can see that it's very similar to the bonus, the concept is the same as the bonus to the employees. Only difference is that here the compensation is being done by issuing shares. That's the thing there. Now, what will happen in the case of declaration of bonus shares? How the accounting, the treatment. So the declaration of bonus shares will increase the paid up capital because that share has a value. But the only thing is that you are not paying for it. So who will pay for it? The company itself is paying for it. And where will the company pay it from? The company has to pay it from its reserves.
Capital.
So,
Capital reserve.
From the capital reserves. Now, the total shareholders' funds will remain the same. There will be no change there. So it's like an entry which there is a plus somewhere and there is a minus somewhere, equal amount. So overall, the total shareholders' funds do not increase. Now, this question is for Anjali again. Total shareholders' funds has two components, Anjali. What are they?
Yes, sir.
Total shareholder, when we say total shareholders' funds, it has two basic components. Can you remember them?
Total share, bonus share, and the one. Yes, sir.
See, in any company, let's say that, the liability side, you'll see capital. And then there's one more thing, and then you say total shareholders' funds. Look at any balance sheet, even the ones which I had, shown in my slides previously. Basically, there are only two components here. One is the
Asset and liabilities.
assets and liabilities are there. No? Now, within the liabilities, long-term funds are coming from shareholders.
Shareholders.
Okay, so equity is one. Equity is one. The other is the retained profits, which are put in the category of reserves. So when we say what are the total shareholders' funds, what we find is that basically the shareholders' funds are equity plus the reserves.
Reserves.
So those are the two. Like in the examples which I had shown you earlier. Just a minute. Let me. Basically, I just wanted to show you this thing again, Anjali. Look at this. The equity share capital is here. See, these are actual figures. So Britannia equity share capital is 24 and the total shareholders funds is 2400. Now the gap here between these two, that is reserves. So basically, whenever we say total shareholders funds, we are talking about two things. One is the actual equity
and the reserves.
And the other is the reserves. That is the basic point I was trying to make. So I'll just go back to where we were. Okay. So this was the first thing here. So now when you give a bonus share, you are increasing the paid up capital of your company. See, if any share issue will result in the increase in the paid up capital of the company. But since you are not asking your, the new shareholders to give you money because they're existing shareholders and you're giving them a bonus, you aren't asking them to pay for the bonus shares. Who will pay for it? You will pay for it. So basically, that amount will be taken from the reserves and surplus. Now, so in a way of say, let's say the language of finance, a bonus issue is sometimes referred to as a recapitalization of the reserves, because you're taking reserves and you're once again putting it back into capital. So it is an accounting transfer from reserves and surplus to paid up capital. So that is a good way to understand it. We look at an example here. Let's take a company called Messrs. Leela Limited. And we look at the situation here prior to the issue of bonus shares. So paid up capital, they have 1 crore shares. The book value of the face value of the shares is 10. So basically, the amount they represent is 10 crore. The share premium already there is 15 crore. The reserves and surplus are 8 crore. So the total net worth of the company is 33 crores. Okay, Lokesh, this part?
Yes, sir.
Now the company issues bonus shares. Let's say that Mrs. Leela decides to go for a 10% bonus, and it is now going to issue 10 lakh new shares to existing shareholders. So a shareholder with 10 shares will get 1 share. So the shares are issued at a market price of rupees 30 per share, rupees 20 over the face value. So they are building a premium in. So now if we look at this, the paid up capital is going to increase to 11 crore because you've issued 10 lakh shares. The face value of the shares is 10. Anjali, this is one point now which you should sort of understand properly. So you had 1 crore shares. Now you decided to issue 10 lakh new shares, and the face value of each share is rupees 10. So 10 lakh into 10 is 1 crore. So now the value of the shares that you have in terms of face value is going to come to 11 crores. You had 10, you issued 10 lakh more at rupees 10, you got 1 crore more, so this becomes 11. But we also say that you issued it at 20 over the face value. Now, the share premium will basically increase by 2 crores. See, 10 crores into 30 is how much? 3 crores. Out of 3 crores, 1 crore is coming here in the paid up capital. 2 crores is basically a premium. So that is added to the premium account. The premium account already was 15. That 2 crore is added there. You get 17 crore. And the reserves and surplus will be reduced by 3 crore. This was 8. We have reduced it by 3. 1 has gone to paid up capital. 2 have gone to share premium account. And the total net worth of the company, when you add this, remains exactly the same as what it was before the issue of bonus shares. That is, it is now 33 crores. Okay, this is good enough?
Yes,
This explanation is okay, so fine. That's one. So, and I've just tried to, later on, if you want to understand how this happened, I've written it out here. The shares were issued at rupees 30. Total amount is rupees 3 crores, 10 lakh into 30. Reserves were reduced by 3 crores. Share premium and capital was increased by 2 crores and 1 crore respectively. So basically, it is an entry which is happening. It's an accounting entry without actually increasing the amount of funds that you have. So that was one part of it. Now, bonus shares and the shareholders' wealth. What about the wealth of the shareholders? What happened to that? So in terms of the theory, bonus shares does not increase the wealth of shareholders. It's quite clear. It will not increase it. If you look at the accounting treatment that we made, we just saw that the net worth of the company did not change. It was 33 crores before the issue of those 10 lakh shares. It remained 33 crores even after the issue of the 10 lakh shares. Now, earnings per share and market price per share will fall proportionately by 10%. This is the theory part, Lokesh. The actual behavior of the market may be different from this, but the theory says that the earnings per share and the market price per share will fall proportionately by 10% because you have increased the number of shares by 10% without actually increasing the net worth. So what you will get is this. So let's say the company has a net profit, earnings of the company is 2.20 crores. And EPS before declaration of bonus shares is 220 divided by 1 crore shares, that is rupees 2.20 per share. EPS after the bonus issue will be what? It will be 220 crores divided by 1.1 crore shares. So we had 1 crore shares, we issued 10 lakh more. So basically now I have 1.1 crore shares and I'm getting an EPS of 2 only. So that EPS has come down.
Yes, sir.
Earning of the shareholder with 100 shares before bonus. So rupees 20 into 100, note after bonus, he will get 110 shares. So before bonus, he was getting 220. Let's say a guy had 100 shares. EPS was 220. So he would be getting rupees 220. And after the bonus, he'll still get 220. Because he has got 10 shares, 110. EPS has gone down to 2. So 110 into 2, he will again end up with the same amount after the bonus shares also. So his wealth is not increasing. Market price of the share will fall by 10%. So the market price will become 27.27. And the market value of the total shares will be 27.27 multiplied by the total number of shares after bonus, 1.1 crore shares, which comes to 30 crore. So essentially nothing actually has changed in terms of wealth. Everything stays exactly as it is. The EPS goes down and the market price also falls. So this is the theoretical way in which it is seen. I have plotted the steps here for you so that it's clear. And so the value of the shares of the company was 30 crores prior to the issue and remains the same after the issue. So if I take the number of shares which the company had before the issue, I multiply by the market value of the share. I take the number of shares the company has after the issue, that 10% increase, multiply by the reduced market value of the share. I end up with the same figure of 30 crores. So as far as the theory is concerned, and as far as the basic arithmetic of this bonus issue is concerned, nothing really changes. Everything stays exactly where it is. So anything to add here, Lokesh?
No, sir, sufficient.
This is sufficient. Now, let us just continue with this. So what are the advantages here for the shareholder? So when a company, remember we said that whenever a company gives dividend or whenever a company basically, takes any action on this front, it is signaling a message to the shareholder. There is a certain message that the shareholder is getting. And in this particular case, indication of higher profits are there. If the earnings do not rise and the bonus shares are issued, the earning per share will go down. This is not desirable. So a company issues dividends only when it is expected an increase in the earnings. Now, bonus shares give a positive signal and have a beneficial impact on share price because there is an expectation. Basic thing to remember here is that there is a feeling that this company is going to do better in the days to come. This is why it has given bonus shares. And that feeling will lead to demand. That feeling will lead to an increase in share price. Then there is a tax benefit. Dividend is included in the ordinary income of the shareholder and taxed at the applicable rate. Bonus shares are not taxable as income. Okay, that's one thing. So if the shareholder sells the shares, he will pay capital gains taxes. So this was one part of it. Now, Future dividends may increase. So if a company has been following a policy of paying a fixed dividend per share, an increase in shares will result in increase in dividends. So it's a simple thing. So if you're following us, like I'm going to give per share this amount of dividend, and now you increase the number of shares, then in that case, the actual amount of dividend paid will increase. But that will, of course, depend on your policy. It's not something which is going to happen just like that. Continuing with advantages for the company. So since you are not actually paying out to the shareholder, there is a conservation of cash. It allows the company to declare the dividend in the form of shares without an outflow of cash. So please note here that the bonus shares is being treated like a dividend without an outflow of cash. So the company is able to retain earnings, which can be used for expansion or taking advantage of an opportunity. So basically what the company is able to get, remember we said that there was a choice that the company had. Should it retain profits and go for growth, or should it give dividends and keep shareholders happy? Now, in the case of a bonus share, you're getting both. Since there is no outflow of funds, you are able to retain the profit within the company, and you can use that for growth. And at the same time, by giving more shares to your existing shareholders, you have also given them something. So you have given them an alternative for a dividend. So the shareholder is also happy that he's got something. As a company, you still retain your profits for future growth. Now, if the company is facing a tough cash situation and has to pay dividend to satisfy shareholders, it can pay a small dividend and issue bonus shares in addition. So even companies which are stretched financially and they actually have a cash problem, for them also this bonus share can be a face-saving device, where they will, instead of giving the usual dividend, pay a low dividend. You have low cash, pay a low dividend, but at the same time compensate the shareholder by giving him a bonus share. What is the assumption here? That in the days to come, I'll do better. And at that point of time, the market price of these bonus shares will rise and shareholders will get a chance to sell them in the market. Or alternatively, because they have more shares, at the end of the day, they'll end up with more dividends in the future. What is the general impact on the market price? So the issue of bonus shares brings down the market price of the share proportionately, and this can encourage small investors for whom the earlier price level was too high. So at a certain price level, let's say smaller investors are finding it difficult to, shell out money and participate in the market. So when the price comes down, it comes within their reach and it's possible for them to invest in the shares. So basically, the advantages of bonus shares are these. Now, in India, here, Lokesh, feel free to come out with any new points which you may have with regard to this.
Okay, sir. Okay.
So the point being made here is it cannot be issued in lieu of dividend. The company has to give a cash dividend and give the bonus shares in addition to it. First point. Now, the next point is that the company can issue a bonus share only if the partly paid up shares are fully paid. So
Yes, sir.
this is a condition.
Yes, sir.
Then the bonus share amount cannot exceed the amount of the paid up shares. It's a bonus. So
Yes,
it's like saying I'm giving a bonus more than the salary. So basically,
No.
the share should not.
Practically not possible.
That's not possible also, but it's
Yes,
there in the
Theory.
law, in the guidelines that you cannot do it. Achha, bonus shares have to be paid out of share premium reserve and other free reserves. Capital revaluation reserves cannot be used.
Yes.
So capital revaluation reserves essentially are accounting treatment of the value of assets.
Of fixed assets, sir. Yes.
Of fixed assets, particularly land. So,
Yes, sir. Land, mainly, example land.
So land appreciates, and because of that, the value actually goes up. So if you want to capture that, you will create this this capital revaluation reserve. So obviously, that is just a notional entry. You cannot use that to for your bonus shares. Then the other point, which is again, I think very fair, a company should not be in default of payment of statutory dues, like salary of employees, employees provident fund, repayments to banks, repayments to
Sir, I think you missed this point.
Yes, Lokesh?
Sir, you missed this point, sir. Company shareholders have to approve the issue. Oh,
Yes. The company shareholders have to approve the issue
approve the issue of shares.
of the bonus shares.
Should be approved in AGM body, AGM.
It should be approved in the AGM. So the annual general meeting of the company is held, and they'll say that we want to do this, and they have to approve it. And so the maximum bonus issue ratio is 1:1, one bonus share for each share held by the shareholder. So these are the basic requirements which have to be fulfilled if a bonus share issue is to be made.
Sir, I think that the maximum has increased, sir. In practical case, IEX, I think everyone knows, sir. IEX share, IEX, Indian Energy Exchange. I have got 2 for 1 share, sir. I mean, latest bonus issue, they have issued 2:1. I mean, 2 shares for every 1 share.
Okay. Good. So that's a new addition then. Okay. Because this was restricted to 1:1. And so maybe, then we need to find out what is the actual, the maximum. What is the maximum ratio which is permissible? Let's say that the example you are giving, they've done 2:1. But then is it possible to go above 2 also? Or is 2 the limit?
Yes, sir.
So, chalo, we'll have a look at that. You have a look, I'll also see.
Okay.
Then another way of, handling this whole issue is to go for a share split. Now, this is the method to increase the number of shares through a proportional reduction in the par value of the share. If you look at, the way, the capital structure charts of many of these companies, and you start from the time that they actually began, and you move up. You can, I'll show you an Excel sheet in a short while. You can see how this part is captured quite well. So here you are increasing the number of shares, but the par value of the share is being proportionately reduced. So basically the share split affects the par value and the number of outstanding shares. Total funds remain unaltered. And an illustration of this is given in this green box here. So paid up share capital, number of shares is 1 crore. Amount is, this is before the share split. Amount is 10 crore. Par value of share is rupees 10. Now you go for a split. So what you do is, number of shares becomes 2 crore. This is one example. The amount remains 10, but now the par value of the share goes down to 5. So we have not actually brought in any extra money or anything. We have just increased the number of the shares. Why are they issued? I think, Lokesh, tell me, why are they issued according to what you've seen?
Sure. Yes.
Okay. Basically, one reason is this, to make trading in shares more attractive. So if the par value of the share itself is very high, as a result of which, over a period of time, the market value of the share has gone up to huge levels. It basically means that very few people can actually participate in the actual sale and purchase of these shares. Even today, there are some companies which have shares where one single share has a market value of 30,000, 40,000.
Yes, sir. Britannia. MRF.
So it's very difficult for anybody to actually, participate there. So when you go for a share split, it results in bringing down the price. Maybe after that, it's possible for more people to, buy the shares. And ultimately, anybody who is looking for capital wants to have as broad a base of shareholders as possible. So this is one big reason here, to signal possibility of higher profits in the future. This is a message which you're giving to the market, that we are reducing our the basic par value of the share, we're increasing the number of shares, and implication, it may be true, it may not be true, but you're trying to put this into the minds of analysts that we will be having a higher profit in the future. And where you are giving number of dividends per share, you're also trying to say that we'll give higher dividends to our shareholders. So before I go into this buyback, I just want to show you that very interesting thing I had with just looking for it. Yeah. I've got it here now. I'll show you. So let me just bring up this Excel sheet here and just show you this. So you can see this location.
Yes, sir.
So this is the capital structure of Asian Paints. So it tracks this data which I got. It is tracking it from 1975. So at that point of time, the par value of the share was 100. In 83, what they did was they actually split the share, and one share became equal to 10 shares. So the par value became 10. It remained 10 till 2012, when it split again. And again, now the value became 1. And presently it is at 1. See this, Lokesh?
Yes, sir.
So this is a company which is actually mainly interested in, I think the whole idea has been that it will, so basically what you're seeing is a 1/100 split. So it was 100, it is now 1. Now another company, I think, which, look at this. Tata this is for Tata Motors. 1945, the value of one share was 100,000. It split 1 by 10. 48, it is 100. 1948. It stays at that level till 1977. No, sorry, till 1987. And then there is another 1 by 10 split, and it becomes 10 rupees, stays like this till 2010, when they split it and make it 2 rupees per, the face value becomes 2, and today the face value of a Tata Motor share is actually 2. So it's pretty interesting the way this has actually happened for different companies. I just thought I'll show this to you so that you get an idea about this aspect. And coming back to our PowerPoint presentation. Now we come to the buyback of shares. So we are basically discussing different ways in which companies can. Just give me a 5-minute break, Lokesh.
Okay.
Just have a bit of water and take a breath, and I'll be back in 5 minutes. So
okay, sir.
Thank you. Oh, that's good.
Yes, sir, we are here.
So buyback of shares. So what is happening here? The company is purchasing its own shares, and in India, the conditions for buyback. So it should not issue shares, will not issue fresh capital except bonus issue for the next 12 months. That means you can't actually get an inflow of money. In bonus shares, there's no outflow, so there's no problem there. The company will state the amount to be used for the buyback of shares and seek approval, prior approval of shareholders. Same thing which we saw in the case of bonus shares. Buyback can happen only by paying from free reserves. The company cannot borrow. And shares once bought cannot be reissued. So many companies have bought back their shares. So these are older cases. Reliance had bought back 1,100 crores of shares. Kirloskar Oil Engines, 300 crores. I have simply given these two examples. They aren't very recent examples. So if you're aware of any very recent examples of buyback or any thing which strikes you, Lokesh, you can tell me.
Infosys, sir, and TCS also.
Acha, Infosys and TCS. How much was the amount in their case?
I didn't remember amount, sir, but it happened recently, sir, 1-2 years.
Acha, 1-2 years back.
Yes, sir. For every 1 or 2 years, Infosys is doing bonus issue, or for every 2-3 years, it is doing bonus issue. Now, this year they have made buyback, sir.
Okay. So basically, see, these are different ways of giving money to shareholders. You can either give the money in the form of a dividend where you're giving cash, or you can give it in the form of a share or something, or a bonus share which will give you the chance to sell it in the future, or you can give them money by taking shares from them and giving them money straight away. So basic idea is, in theory, that the company is supposed to be having a surplus of cash. But I'm sure there'll be other reasons also.
Yes, sir. Because they taking Infosys as example, from nearly 1980, it is doing bonus issue for every 2-3 years, sir. It has not made a buyback in the last 20 to 30 years. So
Okay.
so as a result of this, pooling of shares has increased in the market. I mean, in the outsiders compared to the promoters.
Yes.
So it by buying back the shares, it can increase its stake in the company.
So it's coming back to the original year.
Yes, sir. Yes, to reduce the stake of, to reduce control of the outsiders, because in retail investors are normally less in number. These FIs and DIs from others, they will conquer the company, sir. So to take care of that.
Very true. Very true. Because see, when the shares are available for sale. So institutional investors have a chance to keep picking up shares and increasing their stake. And as their stake increases and they keep getting bonus shares also, it becomes fairly large. That's a very good point you made, Lokesh. Now, here I am looking at how the shares are actually bought back. So the first one is, of course, open market purchases. So companies can buy back their own publicly traded shares at their own pace. So they keep open market when they do this. I'm sure there will be a requirement of informing the exchange about this. So it cannot happen in the very simple way there. So accelerated share repurchases, the company may work with a dealer to quickly buy back a block of shares rather than taking the time to accumulate the shares in the open market. So you get a big share broker in, and then you get him to negotiate for a big block of shares. Maybe some of the institutional investors can be targeted, and then you buy back. The company has to pay for the shares upfront, but then the responsibility falls on the dealer to source the shares. So this is less effort on the part of the company. Keep the cash ready. Dealer finds the persons from whom or the institutions from whom the shares can be bought, and that's it. You make the payment. And the third is through tender offers, more complex, involves actively and widely soliciting others to sell shares to the company. This offer can be made at either a fixed price or through what's known as a Dutch auction, where companies will buy back shares within a set price range. So this is the third type, where you're actually making an offer to the public, and people are coming up with with tenders, and those who are willing to sell their shares at the lowest cost, you will basically go for them. Hence the name, the Dutch auction. So, and the last one is privately negotiated share repurchases. As opposed to making a wide solicitation or open market purchase, a company also might privately negotiate a repurchase from a shareholder. So basically, these are ways in which the company can buy back its shares. Like you said, Lokesh, it's all about control. So if the company is in a position to actually, it has the cash to do this, then the promoters can very well, use it to reduce the dilution that has happened and increase their own control over the market. So that is over the company side. So that's one. Now, what are the effects of the share buyback? So the buyback will permanently reduce the amount of equity capital and the number of outstanding shares. That is the inevitable thing that will happen. Since you are actually returning shares to people, so paid up capital is going to go down. If the company maintains its efficiency even after the buyback, the EPS will rise. So the whole idea is that if you are actually correct in saying that I did the buyback because I had surplus cash, if that is true, then the fact that you use the cash to buy back shares will not affect the day-to-day functioning of the company. The company will not be short of working capital. The company will function just as it was functioning before. Even if there were needs for investing in fixed assets or any form of capex, they are comfortable. That is the assumption. If that is the case, and the number of shares actually come down, then in that case, of course, the EPS is going to rise. The share price will also increase as the PA ratio is expected to be the same after the buyback also. So that is another aspect of this. The company's debt equity ratio will also be reduced. So here I have tried to give an example of this company, Ashoka Limited. It has an equity capital of 200 crores. Reserves are 800 crores. Net worth is 1,000 crores. Par value of shares is rupees 10. Number of outstanding shares is 20 crores. So basically 20 crores, par value is 10. You get an equity capital of 200 crores. They have accumulated profits of 800 crores. You get a net worth of 800 plus 200, 1,000 crores. Now the book value per share is obviously rupees 50. So 1,000 crores divided by 20 crore shares. Sorry, this is not rupees. I'll correct this, Lokesh, before I send it to you.
Okay. Okay.
So profit after tax, assume it at 250 crores. Earning per share will therefore be 1250. Current market price of share is rupees 100. The PE ratio is therefore 8 times. Dividend per share is rupees 6. Debt will be 1,200. Debt.
Sorry, sir.
So the debt equity ratio, the book value debt equity ratio will be 1:20, 1,200 over 1,000. The market value debt equity ratio will be 0.60 because it's going to be 1,200 by 2,000. Now, this I have tried to put here, in this particular thing. So the yellow box here is basically prior to the buyback with the market price at rupees 100. So there are two slides here. this slide and the next slide. In this slide, we are taking a position where the market price is higher than the book value. What happens? And in the other slide, we're taking the reverse position, where the market price is less than the book value. So here, equity capital, 1,000 crore, 800 plus 200, number of shares, 20 crore, book value is 50. Net profit is 250 crore, earning per share will be 250 over 20, this one. So you get 1250. PE ratio, 100, market value of the share by the EPS of 1250 is 8. So just to check, market price 1250 into 8 is equal to 100. So you get 100 multiplied by 20, you're getting 2,000 crores. Just a check there. Dividend per share is rupees 6. So the dividend yield on the market value base is 6%. And the debt equity ratio, book value will be 1200 by 1000, which is 1:20. Debt equity ratio to market value will be basically 1200 to 2000, which will be 0.60. This part is clear, Lokesh?
Yes, sir.
Now, what will be the impact of buyback? So, suppose the company decides to buy back shares worth rupees 120 crores. But they have also decided to buy it back at rupees 120 per share. That means they are going 20% above the current market price. So obviously they have to give some incentive to the shareholder to return the share to them. So they're saying that if you give the share back to us, we'll give you a premium. We'll give you a premium over the market price of 20%. So the shareholders stand to gain 20%. Now what will happen here? So the equity capital will be this. Number of shares will be 19. Earning per share will be 25 by 19, 13.15, because you bought back this. Percentage increase in EPS will be 13.5 is the current EPS, 12.5 was the last one. You'll get 5.2%. Assuming that the price to earning ratio remains constant at 8 times, the market price will be 105.20. So the percentage increase in market price is 5.2. Dividend per share is rupees 6. Dividend yield is 5.7%. So basically what has happened here is that when the book value is, when the market price is much higher than the book value, you don't see too much of a, change here. It's very different when you look at a situation where the market price is less than the book value. The next slide is that. So here, what you see is position prior to buyback with market price at 40. So this 1,000 crore, 2050, this is the same, 1250. P ratio will now become 3.2 because 40 over 1250, P ratio is 3.2 because your market price is low. And then market price 1250 into 3.2 is 40. So the market value of the shares is 800 crores. Dividend per share is 6. Now what happens is, if you're giving a dividend per share of 6 and the actual market value is less, even less than the book value, then the yield goes up. So the yield goes up to 15%. The debt to equity ratio on a book value basis is the same, 1.20, but the debt to equity ratio on the market value basis will be higher. Because since the value of equity, market value of equity has gone down to 800 crores, so basically the debt to equity ratio in terms of market value goes to 1.50. Comfortable with this, Lokesh?
Yes, sir.
Now, suppose the company decides to buy back shares worth rupees 120 crores, 20% above the market price of rupees 40. That means it will now pay 48 rupees to the shareholders if they surrender their shares. The shareholders gain 20%. The company has to now buy 2.5 crore shares because they're spending a total of 120. So 120 by 48, they will have to buy 2.5 crore shares. So the number of shares will now become 17.5. Earning per share will be 250 by 17.5, that is 1430. So the earning per share will increase. It was 1250, gone up to 1430. The increase, as you can see, is significant. It is a 14.4% increase because the number has gone down. P ratio, we're assuming that it remains the same, 3.2. Market price will therefore be the P price into earnings, which will give you 45 into the 45.75. So 40 rupees, it pushes up to 45.75. Percentage increase in share price now is 14.4%. The dividend yield will also be 13.11, but this is not very significant. From the point of view of the shareholder, this part is important. The percentage increase in share price is 14.4%, which we saw in the previous case was just 5.2%. And as far as the debt equity ratio is concerned, it will increase from 1.20 to 1.36, and market value will be 1.50, which was the case before the buyback also. So these are some of the scenarios which we see when we have a position like this. So anything to say here? Okay.
No, sir. No, sir. I will have a look at it when you send this video.
Okay. So basically, this brings us to the end of the dividend section. And after this, so there are two options that we have now. Now, what I really want to do is we go back and look at some of the sections which we have done in the past, like especially like Unit 1 and all, where we were doing corporate strategy and things like that, because now a lot of time has passed for that. Okay. Basically, what I'm trying to do here is just trying to revise in the next, say, 20-25 minutes before we finish today's session, so that you have a better idea, you're better prepared, Lokesh, for tomorrow's quiz. Because since you are the person who's been most regular here, I'm expecting that.
Because I'm working on Sundays.
Huh?
I'm regular because I'm working on Sundays.
You're working on Sundays?
Yes.
Okay. But you'll be there tomorrow, na?
Yes, sir. I will be there.
Okay, great. So, and how is your company going? Your tax stuff and all that? All okay?
Very much busy, sir, now. That's why I told that working on Sundays.
But I really have to compliment you on being very, very regular in attending the class. And it's because, if I have to give this lecture purely on a recorded basis, with nobody there, it becomes a little,
It bore you, sir.
It is boring, and without any interaction, without any questions, it becomes a little difficult.
Yes.
Anjali today has dropped out again. I think this is the second time this has happened, where she begins and then at some point leaves. Hardik, I suppose, will join us tomorrow.
Okay.
I'll leave a message for Hardik where asking him to make sure that he does a bit of preparation for tomorrow's quiz. Let's see if that is possible. And so we'll spend some time on the quiz tomorrow and then go into our section on valuation. Right now, what I want to do is, if it's okay with you, so I think I want to just go back and revise units 1 and 2, quickly. So is that okay?
Yes, sir. Seems they have changed your rooms.
Yeah, yes.
It seems they have changed your room. I think
Who?
room, sir. Room ambient change.
Actually, what has happened is that I have come to Kanpur.
Oh, okay.
I was in Lavasa in Maharashtra.
Okay.
So for the next, I think, 1 month, I'll be here.
Okay, sir.
So probably the background will change. You'll be seeing.
Just a casual talk.
I know. So, so memory test for you, Lokesh. Let's see how much of this you will be recalling as we go through this first part.
Yes, sir. Hope I will.
So here goes. Share screen. Okay. So the first one, this is not for you. It is a corporation. We'll forget about that. And then we come to this point that a company has a vision. It has a mission. And this tells us about what the company wants to do and what its broad goals are. And this is something which the Amazon vision, which every time I use Amazon, I think about this. Seriously. To build a place where people can discover anything they might want to buy online. Like it's quite amazing that they were able to actually think of a vision like this and make it true. Because for most of us, Amazon has provided a selection of products which actually meets this quality. Whatever you want, if you can think of it, you'll find it. The only thing is that you will have to search for it with the right name.
Yes.
And to serve consumers through online and physical stores and focus on selection, price, and convenience. I think this is one company which is doing it beautifully. Then we come to this next point about what is corporate strategy. And the point here was that how do we use the resources of the company to achieve its goals as set out in the mission vision statements, and how do we use the resources to create a competitive advantage for the company? There are two things. It has to consider two factors: resources and of the company, capabilities. And I think Anjali is back. So basically, it is connecting resources of the company. So Anjali, what we are doing now is, we just finished with that section on bonus, share splits, and buybacks. So please have a look at it on the YouTube link. Now what we are doing is we're just trying to revise what we had done in the first unit. The basic purpose of the rest of today's class will be to quickly go through what we have done so that you people are more prepared for tomorrow's quiz. So the quiz may, sort of generate some interest for you. So I thought, let me just try to revise. So the first thing we touched was corporate strategy. And here we said that essential thing in corporate strategy is how do they use the resources of the company to create a competitive advantage. And we said that it should consider the resources of the company, the capabilities and competencies of the company, and the opportunities that the company has given its resources and competencies. So this is the basic task that the CEO has. One thing. Then we spoke about competitive advantage. They should have something unique, something which is there which other competitors don't have. Only then will they be able to find new customers. And this, of course, depends on these three things: the resources, capabilities, and competencies. Resources are the business's assets. They can be physical, intellectual, human, financial. Capabilities are the ability to exploit these resources. They have to be used in a way that meets the firm's goals. And so this was the physical resources, financial resources, human resources, all these together, you use them to meet the goals. Competencies are a cross-functional integration and coordination of capabilities. So you have various capabilities. One of the big things here is your ability to actually integrate these different departments that you have, these different skills that you have, and make sure that they all work as a team for the same goal. So competencies are cross-functional. Functional areas of a business. One example could be operations, manufacturing, marketing and sales, quality control, finance. And when these different departments work together as a team, they manage to create competitive advantage. We gave examples of Apple, where we said that innovation was one of the main, drivers for Apple. And it owns chip manufacturers, controls manufacturing, follows extremely strict software standards, and operates its own shares. See, as far as standards are concerned, you might recall that there was a case when the FBI in America wanted to open an Apple phone, which they had from some suspect, and they were unable to do it. And ultimately, they had to go to Apple seeking their assistance to do it, and Apple, the last I read, had refused to do it on the ground that that goes against their policy. So this was one. Another example we gave was of Maruti Suzuki, where we said that in this particular case, their strengths were their wide network of dealers, their excellent service network, repairs and maintenance was very easy throughout the company. As it happens, it's also a debt-free company. So basically, these examples, look at what these companies actually have, you begin to realize where their competitive advantage actually comes from. So this was one. Components of strategy. So we said that product, market scope of your product, which products will the company manufacture, and in which market will it sell these products, the market segment in terms of age, income, and other characteristics should be defined precisely. The existing players who the company will compete with and the products that they offer will have to be considered. A competitive advantage could arise from technology, design, human resources, marketing, selling capabilities, excellent dealer networks. So it all depends. And you should have a core competence, something that you do better than others. It's a competition. You have to have that extra something. And that is what gives you your advantage. And there has to be a synergy between the product, competency. So that is another point that we made. We explained this through this example of a company that you can read that again. We spoke about diversification and value creation. So to understand diversification, we sort of looked at the concept of securities, which was basically a financial asset. And we said that these are basically known as securities because every financial asset is backed by a secure financial contract. We gave you the example of a fixed deposit. So it's a security. The contract is that basically when you sign that account opening form, there are certain commitments that the bank is making to you, to give you a certain rate of interest, to return the money to you if you demand it back, or to pay you the maturity proceeds at the on maturity, all that. The same thing happens in the case of a mutual fund. So these are all secure contracts, and the same principle holds with shares and debentures. Then we looked at the concept of risk, and we basically distinguished here between systematic risk, uncertainty in the economy. So basically, systematic risk, you think in terms of the whole system being at risk. So anybody who is operating within that system is actually affected by that risk. So something like COVID, war, recession, this would actually be a systematic risk. So everybody who is there will basically be affected. We spoke about unsystematic risk, where we said that this is actually particular to a certain company. We gave examples of this here. So systematic risk examples was government increases the rate of income tax for companies, known as corporate tax. Or, I suddenly remembered one of the reasons why Sri Lanka is in so much trouble today is because the corporate tax there was reduced to a ridiculously low level. So the government was not being able to get revenues from the companies, and this ultimately reduced their
revenue,
the resources that they had, to handle the situation. So in this systematic risk was something which took down the whole country. So unsystematic risk, when there are, let's say, there is a problem with the trade unions, that company specifically suffers. If their R&D effort is impaired in some way, it suffers. If the government increases the custom duty on a raw material used by the company, definitely that company suffers. So these were different examples of how do we handle unsystematic risk. We can invest in different companies. The company itself can invest in different businesses. And in that way, they can diversify the risk that they have, so that if there is a problem, they can manage that. Systematic risk, remember, it cannot be tackled through diversification. Whatever you do, you are operating within the system, therefore you have a problem. These were some examples of how risk can operate and how the company can actually be affected, and how it can reduce the risk. So these were particular examples. I think you'll have to read this to get back to understanding this. So single product company faces the same risk that an investor who invests in only one security faces. So basically you have to think in terms of this, that when a company has only one product, only doing one product, then in that case, the company can actually diversify, get more products in, and that is going to help it. So how can the company diversify? It can produce more products. I gave you the example of that detergent company. And then we distinguish between business level diversification and corporate level diversification. So company presently sells, and what does it introduce? So detergent powder for manual washing, it introduces a new product in the same line, detergent liquid. Toothpaste brings in toothbrushes, cars brings in SUVs, customers remain the same. So basically this is what is happening. You're offering the same set of customers another product from your company, which they were buying from someone else. Here what happens in corporate level diversification is that you begin to make, basically you're targeting an entirely different group of customers. So if you're selling, let's say cars, you, let's say, decide to begin selling chemicals. So that is one example of a corporate diversification. You sell locks and safes and you decide to go for kitchen utensils. So customers for these products are different. There is no relation between them. So essentially, this was one point. Then we looked at the concept of business models. Here, I think, let me just see. I have to do it a little more selectively. Otherwise, we won't finish this. So basically, what is a business model? It answers all the basic questions. What product will the company make? What service will it provide? Where will it, who will buy the company's products? What are the raw materials and how can they be procured? What are the human resources needed to produce the market and market the product? So all this, and will the company use a chain of distributors, wholesalers, retailers? Will the company market exclusively through online resources like Amazon? So this was one. Then we looked at the concept of a value proposition, which has three components. So basically, a value proposition answers that basic question: why should a customer buy a company's product or services? So the proposition or statement is made in such a way that the customer feels that it is better to buy the product rather than other similar products in the market. It is critical. It is a primary marketing tool. Three components are: first, identify your customer segment, your target market. Then be very clear about what the specific value is, and then connect with the customer. So connecting with the customer is an intangible. So you will have to find your own way of doing this, whether it is through the sort of advertisements you have, the public outreach programs you have. This is something which you will have to figure out on your own. I gave you this example from Finolex Pipes, where their main proposition was that we have an excellent product, a durable product, and you should focus on the durability of the product and tolerate the higher price. So that is the point they were trying to make to customers, and a large number of customers are there who actually did not mind the fact that the price was high. Then we looked at other types of business models. We looked at direct sales, where the company sells sales agents who sell directly to customers. There is no retail shop location. Example I gave you was Eureka Forbes. After the internet, you began to have different models, and tech business models began to come in. Another one is franchising. The company sells its business model to a franchisee. The franchisee uses this model to sell the product and make a profit. So McDonald's, Subway, KFC, these are examples of franchisees. And then we said there can be something called a freemium model or an advertising-based business model. So the company provides free services or information and earns revenue by selling advertisements. So YouTube is a very good example here. And then there are subscription models. So this is done where customer acquisition costs are high. Customer subscribes to the service provided by the company and pays an annual subscription fee. So the example I gave you here were of credit information companies, which provide credit reports about a customer to banks. Then we looked at these, the B2B models, B2C models, and I gave you, this B2C non-inventory based models. This was there. And then there were this customer-to-customer models, where we also looked at stuff like OLX, Magic Bricks, that sort of thing. So all are different types of business models. And then we discussed value chain. Covers the various activities that a business undertakes while conducting its activities. Starts with from the time the raw materials are purchased through the processing and marketing, sales, collection of receivables. That the whole area is the value chain. And good CEOs have shown that it is possible to actually cut costs or improve different elements of functioning throughout the value chain. So basically, I've put that here through this figure, showing you the different activities of the value chain with the comment that value can be added at any stage. And then we did business level strategies. So we looked at the BCG matrix, where a company with, let's say, 4 products basically divides its products into stars, cash cows, dogs, and question marks. And we said that stars are those where the company has a high market share and that particular product is a high growth thing. That means basically the more and more people will be buying that particular product. Example I gave you was, you take something like an electric car. Over the years, the sales are going to increase. We looked at cash cow. This is a star product of the past, where now maybe there is not as much demand or as much growth as there used to be. But this company has a high market share and it is in a position to keep minting money. So it's called a cash cow. Dogs are those where the company was a failure and where the market itself wasn't growing. And finally, we looked at question marks, where the company has, it's a high growth area. That particular product is doing well. The company isn't doing so well. So it's a question mark for the company. What should we do? Should we invest more in this particular activity and try to increase our share, or should we quietly withdraw, bowing down to the superior products made by other companies? So that was one thing there. We looked at this example of the growth share matrix. I think going through the whole thing is going to be a little difficult. So, but I would recommend that you have a look at it for tomorrow. It will help you. These tables will also, bring out very clearly how, low growth and high growth markets work. I'll give you a good example of that. And this was an explanation for that. Then we came to a marketing strategy and we looked at Cadbury's. We looked at this was a fairly long thing on Cadbury's, which we discussed that day. And then we looked at strategies for increasing market share. The first, of course, was innovation. Goal is to add value. And then we looked at customer loyalty as a way of increasing market share. So the reinforcing relationships with customers, cultivating their loyalty. This is another very time-tested strategy for increasing market share. Skilled employees can bring in more customers. This is very true, I think, even more true in the service industry, where individual employees can have a great impact on impressing existing customers and bringing in new customers. Because as the reputation of that employee and that organization grows, more and more customers are able to come in. We spoke about advertising, customer connect, and market share, where we said that frequent advertising offers a good opportunity to gain a market share. All good companies have to remain visible. So that is one important aspect. And of course, that companies have to be sure that they market the right people. Then we discussed, how price reductions can also help. Lowering prices can be a solid strategy, but you cannot do this at the cost of quality. If you want to play this game, you will have to work out a way of doing this without actually compromising on the quality. So this was one. So, and then we looked at, in the next section, we looked at actually those different companies, which Unit 2 was corporate objectives here. Let me just share this one with you. So Unit 2 was corporate objectives, where we looked at wealth maximization, as one objective. We showed you through present value what basically present value and discounting, what this meant. This is something which I think we've done, again and again. So I'm sure that there is no doubt in your mind about this whole concept of present value and discounting. We looked at net present value. We'll try to understand shareholder wealth maximization in the context of net present value. And we then looked at this risk return trade-off, where we said that CEO takes investment decisions considering the overall risk, and there is always a trade-off between risk and return. Higher the risk, the higher the return, and vice versa. And the CEO walks a fine line. If he is very conservative, he makes a lower return. If he is adventurous, he may lose the investment. He can make a higher return, but he can also lose the investment. So the big decision, the big problem for him is to walk that line where he keeps the company safe and at the same time manages to give a good return to the main stakeholders. And then we spoke about the agency problem, where basically the management acts as the agents of the shareholders. And they have this huge responsibility to fulfill the goals of the shareholders. So that was about the agency problem. We spoke about agency costs, where, in this particular case, how the management can be incentivized to actually work for the interests of the owners of the company by giving them a stake in the company, by giving them more remuneration and things like that. And then we spoke about other stakeholders. So internal stakeholders are shareholders and employees. External shareholders would be creditors, suppliers, consumers, government, society. So manager cannot ignore any group of stakeholders. All stakeholders monitor the performance of the manager. Most of them have some leverage. And therefore, it is important to take into consideration the interests of these other shareholders. Sometimes they can conflict. So in the long run, the shareholder wealth maximization, or SWM, can be achieved only when the interests of all stakeholders are taken into account. This theory is known as the Stakeholder Theory. So we discussed this in today's world with information technology and people immediately putting their grievances out there. I think it's very, very critical that you manage the interests of all shareholders and not just one. The moment you do that, if you just look after the interests of one group of shareholders, you can be in very, very big trouble. If you want to really check this out, you see how Amazon and McDonald's, both in America, have got into trouble because their management has focused almost entirely on increasing the profits of the shareholders without looking into employees, the interests of employees or the work-life balance of employees and things like that. So if you look at the Amazon thing, you'll find this very easily available on Google. You'll see that, the way they monitor the functioning of an employee through the day, it is very intrusive in nature. And there have been a lot of protests on this. So have a look at that. That will give you an example. And we spoke of the management as a trustee. Because the management has a responsibility to all the different stakeholders that the company has, and they have to harmonize the interests of these different shareholders. About profit maximization, basic thing which you need to remember is it's a short-term goal, and it's primarily restricted to the accounting analysis of the financial year. Then we discussed this corporate social responsibility, and after this, we looked at externalities. For example, here, what is happening? You have a river which has been polluted, and the company is actually responsible for it because it just didn't care about the environment. So we said that the costs of an externality can be is basically to people outside the company. Similarly, the benefits of an externality can be for people who are outside the company, and company itself is not directly, let's say, it doesn't lose or gain. Outside people, that's why it's external. They are the guys who lose or gain. And then we spoke about whose responsibility it is, how earlier on it was considered to be the responsibility of the local government. If the river is polluted, air is polluted, who should fix it? Local government. Government is nowhere, the company is nowhere responsible. How now we have come full circle and we begin to question the company itself. And then we looked at how do we overcome externalities. That means push companies into following policies that are much more, let's say, environment friendly and stakeholder friendly. We spoke of taxes as being one way. There are laws, punitive sections in laws which also help. And CSR activities can also help to reduce the impact of externalities. Then we spoke about some of the more, the legal aspects of CSR, role of the board, how the CSR is mandatory. So any company, which is in that range has to spend at least 2% of its average net profit for the directly preceding 3 financial years on CSR activities. What are the types of CSR activities? We looked at that. And we looked at these top companies who are there in CSR in 2021. There was Infosys, Wipro, ITC. And then we looked at this concept of a triple bottom line: profit, planet, people. So ultimately, this is that same concept of stakeholder, the fact that all stakeholders have to be taken into account. And this is essentially a green initiative because you're talking about the planet itself. So a company is supposed to be, aware of the damage it can inflict on the environment and take it from there. So this section here was about the 3 Ps and the benefits of the thing. I hope at least that by quickly running through some of these slides, I have been able to So I think that's about it for today. Lokesh?
Yes, sir.
So we'll end this
Yes, sir.
rushed revision of units 1 and 2. 3 I did not touch because I expect that was covered recently. So you probably have a better idea of that. And tomorrow we'll have this quiz. I hope it's fun. Revise a little, and we'll see. We'll take you through around. Let's see how many questions I can figure out for you. We'll do that tomorrow, and then we'll move on to the next section of the next unit, which is basically about valuation. Okay.
Okay.
Okay, sir. Thank you, sir.
Thank you.